Alright, so let's talk about something that's hitting pretty much everyone's wallet these days: cars. It used to be that getting a new set of wheels was a milestone, something exciting. But lately, it feels more like signing up for a financial marathon you didn't train for. We're seeing prices skyrocket, interest rates go through the roof, and honestly, it's becoming a real problem for a lot of people who just need a reliable way to get to their jobs, drop off their kids, or, live their lives. The dream of owning a car is turning into a financial nightmare. In 2025, more Americans are falling into massive debt just trying to drive to work, and the worst part? Most people don't even realize how bad it's gotten. We're not just talking about the sticker price. It's the loans, the insurance, the maintenance. The whole package is becoming a heavy anchor. In this video, we'll reveal exactly what's going wrong in the car market, why even smart buyers are getting trapped, and how you can protect your money before it's too late. So, stick around, because this is information you absolutely need to hear. Welcome to the Wealthy Path, where smart money leads to real freedom. So what in the world is actually going on with car prices? It's not just your imagination. Things have gotten seriously expensive. According to Kelley Blue Book, the average new car price in 2025 is hovering around a staggering $48,000. That's a massive amount of money, more than what many people make in an entire year. And it's the average. This means plenty of popular models, the kind of cars families rely on, are pushing well into the 50,000s or even 60,000s. And if you're thinking, okay, new cars are out, I'll just get a used one. Well, hold on a second, because the used car market isn't exactly a bargain bin either. The average price for a used car? We're looking at about $26,000. We're talking about an increase of more than 30% from what we were seeing before the pandemic hit. So, the big question is, why? Why are we seeing these astronomical prices for both new and used vehicles? It's not just one single thing. It's more like a perfect storm of factors all hitting at once. A major culprit has been the persistent supply chain issues. We heard a lot about the semiconductor chip shortage, and that was a huge deal because modern cars are basically computers on wheels. Fewer chips meant fewer new cars could be manufactured, leading to a classic case of low supply. When there aren't enough new cars to go around, the demand for the ones that are available and for used cars naturally skyrockets. Then, tied directly to those supply chain woes, we have the issue of low inventory on dealer lots. For a long time, dealerships just couldn't get their hands on enough cars to meet customer demand. This scarcity gave dealers a lot of leverage. They didn't need to offer big discounts or incentives to move cars because they knew if you didn't buy it, someone else probably would, and likely pay full price or even more. And let's not forget about rising demand itself. Even with higher prices, many people still needed or wanted to buy cars. Perhaps their old car finally gave out, or their family situation changed, or they simply had been putting off a purchase and couldn't wait any longer. Plus, during certain periods with travel restrictions and more people working from home, there was a shift in spending. Some folks who saved money on vacations or commuting might have decided to put that towards a vehicle. Of course, we can't talk about rising prices without mentioning the broader economic factor of inflation. Everything has gotten more expensive, from groceries to housing, and cars are no exception. The cost of raw materials needed to build cars, like steel and aluminum, went up. The cost of labor went up. The cost of transporting those vehicles to dealerships went up. All these increased costs for manufacturers inevitably get passed down to the consumer in the form of higher sticker prices. So even if the supply chain issues were to magically disappear overnight, the underlying inflationary pressures would still mean cars are more expensive than they were a few years ago. It's a multi-layered problem. All right, so you've braced yourself for the high sticker price, you've scoured the listings, and maybe you've even found a car that seems, well, not outrageously overpriced in this crazy market. But here's where another major hurdle slams down: financing it. For the vast majority of people, buying a car means getting an auto loan, and this is where things have gotten particularly brutal recently. Even if you manage to negotiate a halfway decent price on the vehicle itself, the interest rates on auto loans right now are, frankly, crushing. Let's look at the numbers, because they really tell the story. For new cars, the average auto loan interest rate is now hovering over 7%. And if you're looking at a used car, which many people turn to thinking they'll save money, the average interest rate is even higher, often above 11%. To put that into perspective, just a few short years ago, during the height of the low interest rate environment, it wasn't uncommon to see promotional financing offers of 0% or 0.9% from manufacturers, especially on new cars. Those deals are practically extinct now. What used to be a relatively minor cost of borrowing has transformed into a significant additional expense that can add thousands to the total cost of your vehicle. Think about the difference this makes. If you were lucky enough to snag a 0% financing deal back in the day, the price you negotiated for the car was pretty much the price you paid, just spread out over time. But now, with rates at 7% or 11% or even higher depending on your credit score and the lender, a substantial portion of your monthly payment is just going straight to interest, especially in the early years of the loan. It's money that isn't building any equity in your vehicle. It's just the cost of money, and that cost has become incredibly steep. So, we've established that car prices are through the roof, and interest rates are making borrowing money incredibly expensive. What's the direct consequence of these two factors combined? You guessed it. Monthly car payments have absolutely skyrocketed, reaching record highs. This is the number that most people focus on when they're budgeting for a car. And right now, that number is frankly terrifying for a lot of households. Let's get specific with the figures because they paint a stark picture. In the US, the average monthly payment for a new car has now climbed to over $740. And for used cars, which people often turn to for affordability, the average monthly payment is around $550. Think about what that means for a typical household budget. For many Americans, a payment of that magnitude represents a huge chunk of their monthly income, potentially making it one of their largest expenses after housing. It's a commitment that can severely impact financial flexibility. The reality is that current average monthly payments are at a level that is simply unsustainable for a large portion of the population, and it's forcing people to make some very tough choices about their transportation needs and their overall financial health. All right, so you've navigated the high sticker prices, you've winced at the interest rates, and you're trying to stomach the monthly payment. But just when you think you've got a handle on the cost, you step into the dealership's finance office, and that's often where another gauntlet of expenses gets thrown your way. Dealers have become incredibly creative, especially in this market, at tacking on extra fees and pushing unnecessary add-ons that can inflate the final price of your car by thousands of dollars. One of the most notorious culprits we've seen in recent years is the market adjustment fee, or dealer markup. This is essentially an extra charge that dealers add on top of the manufacturer's suggested retail price, MSRP, simply because they can, due to high demand and low supply. You might see it listed as ADM for additional dealer markup. There's no real value added for this fee. It's pure profit for the dealership. Always question these and be prepared to walk away if they won't remove or significantly reduce them. Then there's the onslaught of add-ons and services that get pushed heavily in the finance office. We're talking about things like extended warranties, gap insurance, tire and wheel protection, paint protection film, fabric protection, and so on. While some of these might offer a degree of peace of mind, they also come with hefty price tags and significant profit margins for the dealer. You need to carefully evaluate whether you truly need each one and if the price is justified. Often you can find similar services or products for less money elsewhere. The key to protecting yourself from these hidden fees and dealer tricks is to always insist on an out-the-door price quote in writing before you agree to anything or sit down in the finance office. This price should include the cost of the car, all taxes, all mandatory government fees, and all dealer fees and add-ons. This way, you see the total final number you'll be expected to pay. Okay, so we've painted a pretty bleak picture of the current car market. Prices are high, interest rates are up, and dealers are employing all sorts of tactics. It can feel overwhelming, but understanding what not to do is just as important as knowing what you should do. Making a few key missteps in this environment can lock you into a bad financial situation for years. First and foremost, and this might sound obvious, but it bears repeating in this market, don't buy a brand new car unless you absolutely, positively need to and have exhausted all other viable options. The allure of that new car smell is strong, I get it. But new cars come with that massive depreciation hit the moment you drive them off the lot. We're talking 20 to 30% of its value gone in the first year alone. In a market where prices are already inflated, paying a premium for new and then immediately losing a huge chunk of that value is a recipe for financial pain. Next up, and this is a big one, avoid long-term auto loans like the plague. I'm talking about those 72-month, 6-year, 84-month, 7-year, or even longer loans that dealers love to push because they make the monthly payment look deceptively affordable. Yes, spreading the cost over more months lowers the payment, but it dramatically increases the total amount of interest you'll pay over the life of the loan. You'll also be upside down owing more than the car is worth for a much longer period. This is a dangerous place to be, especially if your car gets totaled or you need to sell it unexpectedly. Stick to shorter loan terms, ideally 48 months, 4 years, or 60 months, 5 years, at the absolute maximum, if you must finance. Another critical mistake is ignoring or underestimating depreciation. As I mentioned, a new car loses a significant chunk of its value very quickly, but even used cars depreciate, albeit usually at a slower rate after the initial big hit. When you're choosing a car, consider its expected depreciation. Some makes and models hold their value much better than others. Okay, enough doom and gloom. While the car market is definitely challenging, you're not entirely powerless. There are smart moves you can make to navigate this landscape and protect your finances. It requires a bit more effort and diligence than it used to, but by being strategic, you can still find a reasonable solution for your transportation needs without getting financially wrecked. My number one recommendation, especially in this current climate, is to strongly consider buying a reliable used car that's about 2 to 4 years old. Why this specific age range? Because a car in this sweet spot has already gone through its steepest depreciation curve, that big 20 to 30% hit in the first year and then some more in the second. The original owner absorbed that loss, not you. Yet, a 2 to 4-year-old car is often still relatively modern, has many of the latest safety features, and if well maintained, can have many years of reliable service left. You get a much better value proposition compared to buying new. Before you even step foot in a dealership, or even start seriously browsing online, get pre-approved for an auto loan from your own bank or a local credit union. This is a game changer. Credit unions, in particular, often offer some of the most competitive interest rates, sometimes significantly lower than what a dealer's finance department might offer you, especially if the dealer is marking up the rate for their own profit, which they often do. Walking in with a pre-approval letter in hand gives you tremendous bargaining power. You know what you can afford, and you have a baseline rate to compare against any financing the dealer offers. When you're shopping for that used car, focus on reliability. Do your research on makes and models known for their longevity and lower maintenance costs. Resources like Consumer Reports, J.D. Power reliability ratings, and even owner forums can provide valuable insights. A slightly older car from a brand known for its dependability, like many Toyotas or Hondas, can often be a much smarter buy than a newer car from a less reliable brand, even if the upfront cost is similar. You'll save money in the long run on repairs and headaches. Don't just look at the purchase price. Consider the total cost of ownership. Don't be afraid to expand your search. So, there you have it. The car market is undeniably a tough, expensive place to be right now. From sky-high prices to crippling interest rates and sneaky dealer tactics, it's easy to feel like the deck is stacked against you. But as we've discussed, you're not powerless. Knowledge is your best defense, and understanding the pitfalls and opportunities within the current market can make a huge difference to your financial well-being. The key takeaway is to be patient, do your homework, and don't let emotions or pressure tactics dictate your choices. Consider reliable used cars, get pre-approved for financing, scrutinize every fee, and be prepared to walk away from a bad deal. Your goal isn't just to get a set of wheels, it's to do so in a way that supports your overall financial health, rather than derailing it. If this video helped, please give it a thumbs up. It really helps the channel out. And consider subscribing for more smart money tips every week. Thanks for watching, and I'll see you in the next video.